The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
Friday, and we're going to be talking about money. So, as I started out in this business, I worked for a large brokerage firm, a national brokerage firm, and brokers would come and go. And the way they would come and go is they would get an offer from another firm, a big offer for a big move, and they would leave on a Friday afternoon, and the management would take the accounts and distribute those. And the larger the producer you were, the better the accounts you got. Well, as I was starting out, I got a couple little tiny accounts. One of those accounts had purchased one mutual fund, and they put $10,000 into that mutual fund. Now, the point of that whole thing is that wholesalers, mutual fund wholesalers come around, and mutual fund wholesalers are actually people that are employed by the mutual funds. They go into brokerage offices and they try to get the financial advisors, we were called stockbrokers in those days, of course, they try to get the stockbrokers to buy their mutual funds, to put them out to their clients. And they come in and they make a presentation and they'll say, this is how well this fund is done. This is the reason to do this fund. So as I'm sitting in this presentation, and as a rookie, you go to all these things. You learn a lot of information, supposedly. And I'm sitting and listening to this presentation about this particular mutual fund. And the wholesaler's describing this fund as having a return over the last 5 years of 20% per year. 20%, 20%, 20%. Remarkable performance. And he's trying to get us to buy the mutual fund. Now, that sounded kind of familiar. So I went back, as there was a break in the presentation, I went back and looked at this account that I had inherited. And this woman had purchased several years before this very mutual fund. And she had paid $10,000 for it. And at this time, as I looked at that account, it was worth $8,000. Now, if it had actually done 20% per year, it would have tripled in that period of time. It shouldn't be 10,000. It should be 30,000. It shouldn't be 8. It should be 30,000. So that began to raise questions in my mind. I came back and I asked the question, and the wholesaler couldn't really answer the question. But what I learned is that if a mutual fund's not doing well, it can be merged into another mutual fund. And in this case, this was a larger mutual fund, so they merged it into a smaller mutual fund, and they kept the name of the larger mutual fund, but took the track record of the smaller mutual fund. So therefore, the smaller mutual fund, which had a track record of 20% per year, looked very good, but the big mutual fund got the name of the small one. Now, there was an article in Investment News last month that says 23% of all U.S. and international mutual funds have either been merged or liquidated in the last 5 years. Think about that. 1 out of every 4 mutual funds from 5 years ago does not exist today. 1 out of 4. And it's almost always a poor performing mutual fund that rolls into a better performing mutual fund. And for the poor investor that invests in a poor performing mutual fund, they end up with a track record which looks remarkable. But in fact, their dollars don't look so good. My guess is that as we go forward this year and into next year, we're going to see a lot more of it. And it's not just mutual funds, it's ETFs that are happening that way. It's a whole lot of things that are being consolidated rather than just running out of business, rather than telling people to move your money from a poor performer into a better performer. The fund companies don't tell you that. They just make the merger. And in many cases, You don't know your fund has been merged unless you look at the statement and it looks like a name change, but you don't realize how poorly you're doing. I would guess there's going to be a lot more because what's going on today is earnings, and it's going to be that situation. The earnings had problems last year. They're going to be even worse in the first quarter. When you're talking about real estate, it's location, 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 right? When you're talking about stocks, it's earnings, earnings, earnings. The first quarter's 2016 earnings season's begun, and many are expecting it to be one of the worst since 2008, 2009, that time period. The average comparison, if you look at how companies have done, the average company compared to last year, their earnings are going to be down 9.1%, almost 10% down this year compared to last year. If that was the situation for the market, you would expect the market to be down 10%. But remember that old thing, on averages, if your head's in the oven and your feet are on a block of ice, your average temperature is very comfortable. Well, that's what's going on in today's market. Energy stocks, those stocks that are related to energy, not alternative energy, but energy. Energy stocks, the earnings comparisons are expected to be down 103%. They're expected to have no earnings, in essence. The earnings that they showed last year for the first quarter have essentially gone to zero. That means a few companies will have positive earnings. Some will have losses. A significant number will have losses. The materials sector, the mining, the coal, Peabody Coal filed for bankruptcy. But the mining sector, the materials sector, that's supposed to be down almost 23% comparing year to year. And financials, those banks that have financed those oil companies and the drilling companies and the equipment makers, they're expected to be down about 11%. And some of those have been reporting. Banks have been reporting not a very pretty picture in terms of earnings. So it's that situation where the head's in the oven, the feet are on ice, the average temperature is comfortable. Energy's down, materials are down, banks are down, financials are down, but there's areas in which there's positive returns. When you look at what's going on in the economy, and I've talked about this before, it's a time when it's going to be difficult for investors, but not necessarily for investing. It's a time in which we live in what Richard Bernstein, the former strategist for Merrill Lynch, Bernstein called a Walmart world. We live in a time when the financial companies, those companies that depended upon and bought a lot of credit, that did a lot of financing, are struggling. And those countries which built large facilities and did exploration of oil, built aluminum plants, built steel plants, built big factories, and did all that on credit, they're now suffering. And so if you look at the things that are credit related, whether it be the emerging markets, whether it be junk bonds, whether it be gold, whether it be commodities, whether it be oil, whether it be private equity, whether it be hedge funds, those areas are all suffering. All those were credit related, and the credit bubble burst. And we're going to have a time to work through this whole thing. But being in the right place at the right time, I feel, is going to be very, very good. If you look around Seattle and look at what's happening. Although we're one of the hottest markets in the country, we're not exceptional. Puget Sound Business Journal, in their last week or the week before, reported there were 60 cranes building high-rise buildings. And that's probably just the big cranes, not the small ones. I signed my office lease 18 months ago for $32 a square foot. Today there's talk of prices at $55 a square foot for office space. Business is good. Business is very good. It's not necessarily the heavy industries that are doing well, but business is good. One of my favorite quotes was something that Daniel Patrick Moynihan said: everyone's entitled to their own opinion, but nobody's entitled to their own set of facts. The fact is, the economy's doing well. The consumer's doing well. In 2014, the average consumer spent $2,500 on gas, 4.2% of their income. 2015, they spent $650 on gas, 1.1% of their income. That's like having a 3% raise. JP Morgan did an actual look at their accounts of their customers and found that customers were saving, of every dollar that they'd saved, every one of those almost $1,800, they were saving 11 cents out of the dollar, but they were spending 89 cents, which means that every single consumer, is spending $1,646. That's going to add 1.5% to the GDP in this year. So we may be dragged down by some of the capital spending, oil and mining that's pulling down, but the consumer is doing well. The budget deficit has shrunk. We're at a lower level now than we've been historically on the average. We're seeing the workers, and the unemployment is at 5%. That's considered very often full employment. Don't go away, because I've got more to say on this whole subject right after this commercial break. Don't go away. We'll be right back.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I've been talking about earnings, and the big thing that's going on with earnings beginning in the first quarter, it's going to go on for most of this year, is that certain companies, certain industries are really suffering. While average earnings are going to be down 9% or a little over 9% when you compare the first quarter earnings compared to last year's first quarter, it varies within industries. Energy is going to be down 100%. The average energy company is going to actually just break even. Some are going to be underwater, some are going to be above water, but the average is going to be way down. And in the materials section, or materials industry, that one is also going to suffer. The financials are going to suffer. And what that means is if you have one industry that's down 100% and the average is minus 9%, that means some are doing better than zero. That means that you've got some companies that are actually growing and doing very well. And that's going to be the story, I believe, for a lot of this year. Now, that has implications for investing. In the past, the idea or the concept has been, or people have felt, that active management has been failing. And if you look at mutual fund withdrawals, a lot of funds have come out of active funds to go into index funds. And there's a reason for that, because rather than switching from one hot fund to another fund, being in an index fund puts you in the average of the market. But this year, this year and last year, and maybe for another couple years, the index funds are not going to do as well probably as the actively managed funds, or at least the well-managed active management funds. And money managers who are able to perceive what's going on are also going to do a lot better. Instead of a break-even year, they're going to be up 5% or 6%. If the average market is up 5%, they're going to be up 10 or 15%. That's the nature of where we're headed, is to be in those things which are doing well and out of those things which are doing poorly. And there'll come a time when the shift will be on, and there'll be a time to buy the energy stocks. There'll be a time to buy commodity stocks. When that is, well, we're not going to talk about that because my clients will know, but that's another story. That's where we are today. And we live in this world where you hear presidential candidates say we're headed for a great crash. No, we're not headed for a great crash. When you have unemployment at 5%, when you have companies that have record amounts of cash, when you've had companies that have had record earnings, and even with the down movement the last couple quarters in earnings, they're still making a whole lot more money than they made in 2008, 2009. We're not headed for a crash. There is an article. It was written by Bob Various. It's in the Financial Planning magazine that came out this month, or on maybe it's on Wall Street. I read so many magazines, they all start to run together. It's an article where he talks about if you want to get really well known, just pick one day a week and call a radio station or call a media outlet, TV station, radio station, newspaper. Call them and tell them you're predicting the market's going to crash. He said, almost certainly you're going to be quoted. If you say the market's going to do well, nobody really cares. But when you can say the market's going to crash, you get a lot of publicity. One presidential candidate today came out and said the market's going to crash. He's wrong. He's really wrong. The chances of that are very, very low. We live in a time which, if you look at the facts, we're doing very well. Moynihan, my quote is that everyone's entitled to their own opinion, but no one's entitled to their own set of facts. I think things are going to be good. I think you have to be in the right place at the right time. It's all about earnings, 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 but it's going to be a very good time. But as we talk about difficult times, my guest today is Gail Bush, who is an attorney who specializes in bankruptcies of all things. Welcome to the program, Gail.
Thank you very much. Good to be here, Mike.
I didn't mention the firm name.
Bush Kornfeld.
Bush Kornfeld. Sorry about that.
It's all right.
So let's start with your background.
Well, I'm a Northwest kid. I grew up in Oregon through high school. Went to Seattle Pacific University and University of Puget Sound Law School, which is now owned by Seattle University. I worked in the days at Boeing during my years in law school, and then became a full-time lawyer in 1977. I've worked for a bankruptcy law firm since 1978, or own one, both. And we specialize in representing debtor companies who have financial stress. For the first 10 or 15 years of my career, I represented banks. I came to not enjoy that. I enjoyed working on the other side of the table from banks. I had a very good rapport with them. I understood them. I had represented them for years. Rayner Bank, Security Pacific Bank, and then B of A were all clients of mine at one time. And I found that they really needed good representation on the other side of the table for them to be successful. So our firm specializes in representing debtors. Most of our work comes from the largest law firms in the region. Occasionally we get good cases referred to us by banks where they send us their customers because we've had good success in being straight with banks. The companies haven't always succeeded, but it hasn't been for lack of trying, and it hasn't been for lack of rational thought process. So I see a lot of industries, and Mike has correctly noted that there's a tremendous amount of stress in energy, and it's not going away. It probably will be with us for at least another year, according to the smart people that I believe in, and it could be longer than that. I think the optimists feel that things are going to start turning around maybe in the last month of 2016. The pessimists see it going on considerably longer than that, maybe 2 or 3 years, where it just continues to be a real challenge to survive.
I think it's a real challenge worldwide to survive. And, you know, there's a meeting going on in Doha that of the major oil producers, and they're coming together. But according to the numbers I read, those big oil producers have used up $315 billion of their reserves. So cutting back on production is probably not in the cards for them.
Statistically, I think of the public oil companies worldwide, and there's about 550, people who look at those balance sheets will tell you that about 175 of them are in great peril of failure in the next 12 months. Now, that doesn't mean all of them will, all of them won't, but many of them will.
So what happens in the process where you have 175 or 150 or 200 companies? What happens on a company-by-company basis for handling this? The oil prices come down. Their break-even point to meet all their obligations may be $70 or $60 or $90 or whatever. They can get by day-to-day at $30. What happens in that process? How do they keep from being foreclosed? How do they continue to operate?
There are really about 5 categorical responses that they take. If it's really hopeless, most of them try and sell their assets, and they utilize bankruptcy to sell their assets. It's called a 363 sale, where a court can approve a sale of assets out of bankruptcy to a buyer, and the buyer acquires those assets free and clear of liabilities. There are a lot of borrowers who are debtors who have value in undeveloped wells that have some attraction to long-term vulture speculators who think when I'll buy these assets, I'll just sit on them and I will improve them when the prices start to raise, and I hope I guess right, because the people that get really well treated when they're done are the people that figure out about a year in advance and begin their process.
So we saw a lot of that in the real estate market, right?
Mm-hmm. Mm-hmm. We did. In the Northwest, we had a tremendous amount of failure. I probably, in my office, saw $3 billion of bad real estate loans in a 2-year period from 2008 to 2010. Most of that product has been absorbed by 5 major national builders, and now they have been building hard and fast in the Northwest for the past 3 years.
And they probably bought it
right
at pennies on the dollar.
Other approaches to oil customers beyond just submitting to bankruptcy, they borrow more money. If they have assets that have value, they try to borrow and use that to meet their operating expenses. They may try and sell some of their assets to save the others. They may try and bring in equity funding, sell equity in some of their products. And then there's been a lot of cost cutting. It's not really cost cutting, but CapEx expenditures are way, way down. Mm-hmm. That's been a very heavy area where you can improve in this industry. And people didn't really start to do that until the second half of 2015. And they still have a ways to go.
So we're coming to a commercial break. Don't go away because we've got a lot more to cover with Gail. Very focused time of how this impacts investments and where we're going. So don't go away. We'll be right back after this commercial break.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
35.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I'm here with Gail Bush of Bush Cornfield. We've been talking about bankruptcy and especially in the oil patch. So let's go back and talk about what happens to the 175 or 150 companies which are faced with a deteriorating financial situation. I guess that's the best way to put it.
Mm-hmm. Well, they look both internally to cut. And there's been a tremendous amount of overhead, essentially salaries cut from operating companies in the past 12 months I think there was a disbelief that this was really bad and clear through the first half of 2015.
They should have been listening to my radio program. I told them it was going to be bad.
They were in denial. And now they're having to make across-the-board heavy cuts, and they're not able to spend money on CapEx like they used to. They're really cutting dividends to shareholders, although that's the last thing they want to do. It's the first thing they should have done. But they are now just having to cut. Banks are taking secured positions everywhere they can get them, first, second, third place on assets. There's a lot of lending being done by private funds, and they're guessing. I think that what they're looking for are value pockets primarily in undeveloped wells where they can go down quickly when things change. And there's an interesting thing to know about the life cycle of a producing oil well. You can say a well may have 20-year productive life, but what you'll find is that maybe 75% of the oil that's ever extracted from that well is going to come out in the first 2 years. So the people who have a battery of undeveloped wells but can get rigs in the ground, equipment on them, and get them started pumping are the ones who are going to make heavy money when this market comes back, assuming it comes back. But
it's going to come back.
I look at every business I've seen, and it goes up and down over the years. I thought logging was extinct in 1990, and I had put a ton of old growth logging companies through bankruptcy proceedings over in the peninsula and on the west side of the state of Washington. It came roaring back. Well, not the old growth, but logging. Trees keep growing. Builders keep building. You need that product. And
you do need to drill the oil.
Mm-hmm. Mm-hmm.
And, we have a good example that was recent with the home builders and what went on.
Yeah, there was a lot of product of developed subdivisions that had the infrastructure in the ground that just hit the wall when in the second half of 2008, and we saw Washington Mutual fail. We saw some of the large, Bear Stearns failed, Lehman failed. We saw, and that just cut the heart out of the home building market. And the second home market was even worse, but we saw the trading value of unbuilt building lots sell between 15 and 20% of cost.
Yeah.
So if you bought acreage and you put in the infrastructure and 2008 happened and you were holding 150 lots in a division that you were just getting ready to build on, somebody bought that for, usually these single-family lots sold for about $20,000, and the infrastructure cost was about $100,000 to $105,000. That's an average, but those are pretty square numbers. And all of the national home builders jumped on those lots and said, I know, this will be back. And they had to sit on some of them for 3 years to 5 years, but they can outcompete any small independent builder who doesn't have inventory that was acquired during that time period. Now, that's going to revolve out. They're building so fast that they're going to revolve out. But it's certainly the same, I believe, in oil, the same thing will happen.
I believe that's going to happen as well.
It has a lot of inertia built in, though, because the amount of capital to take an undeveloped well and bring it to production is heavy money. There's a lot that has to be done to put that well in. So it's going to take quite a bit of money, quite a bit of risk to get those back to where you're making 20% return in the energy industry. But the smart people and the people who are well-funded now are the ones who are going to come out on top. There's no question about that.
And I think there's a parallel with home building as well. We've seen the change from the single-family home into multifamily. And with oil, we're seeing the change with alternative energy, with solar becoming economically viable in 47 out of the 50 states. We're seeing the energy from solar, from natural gas, and some of the other alternative energy areas, which will affect the oil.
Right.
And yet, we're still going to continue to need the oil, but it's going to be slower growth, probably, but it's going to be a time of. But
it all spills over into the financial industry because the amount of lending in oil and energy is high. There will be bank failures that happen because of this. And then you'll have the smart buyers. There's a tremendous amount of debt buying that happens now. It used to be banks just wrote them off, closed them down. Now they will put together a portfolio of bad loans, sell them. I see loans today that are performing in the $30 to $50 million amount, making payments every month. And the actual note and paper is owned by buyers who spent maybe 17 cents on the principal. So they have a loan that's generating 5% of $30 million per year that they spent $6 million to buy. So they're making about an 80% per year return on their investment.
But they also bundled that with other mortgages that have gone under. So
yes, but if you only pay 20 cents, you can typically come out even if it fails.
Yeah,
even if it fails, you can make a good return on your investment.
Yeah.
And there are institutional buyers like Beal out of Texas, First Citizens out of North Carolina, who do little else but venture and vulture buy and sit there and clip coupons for years.
It's a specialty field. So great for the great insights. Thanks for being on.
I appreciate the opportunity very much, Mike.
It's a very specific area, and yet one in which you've seen a lot of things happen over the last 10 or 15 years.
That's true. That's true, and we're seeing more happen now in the Northwest. So
if someone needed to get a hold of you, how would they do that?
The easiest way to find us is on the internet. Our website is BSKD, Boy Sugar Kite Dog, and all of our information is there. We're on the 50th floor of 2 Union Square. We've been in 2 Union Square for about 23 years. Same secretaries, same lawyers, same people. My phone number is 206-521-3859. It rings on my desk, and I'll answer the phone.
That's great. And I'm sure there may be people that are listening today that are struggling financially, involved in something, and so I would guess that you would give them counsel and advice on how to proceed from there.
Happy to do that. I'll do a lot of that.
Great. Thanks, Gail.
Thank you.
I want to turn to one of the things that happened this week, very big in my industry. Department of Labor released the final regulation for the fiduciary standard. It won't go into effect until April of next year or April of 2018. It's not completely done, and who knows if another administration will come in and reverse the rule. But for now, it stands. And the experts, most people are predicting that it's going to stand. So fiduciary rule. Fiduciary, what does that really mean? It means that you make every decision in the best interest of your clients. Now, that seems really straightforward to me. Really straightforward. So why do you get part of the rule requiring 88 pages in this bill to explain what that is? The reason is because there was a lot of pushback. The reason that it was important to do this was because of what's going on. 72 million people participate in 401k plans, 483,000 plans. And it's been a wonderful financial asset for the brokerage firms, for the banks, and for the insurance companies. But the problem is it's not always been good for the participants. 54% of U.S. workers have less than $25,000 in retirement savings. 27% less than $1,000. Fewer than 75% of people participate in a lot of the plans. And the average balance for those that are retiring with 30 years experience is $144,000. That's enough, according to the General Accounting Office, for a person to have $405 per month in retirement. That's awful. But the plans are really profitable for the banks and for the insurance companies and the brokerage houses that run them. In 2008, when the studies were being done, and even before that, they found up to 17 different fees. And you'll have to wait and hear the rest of this because we're at a commercial break, so don't go away.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
And if you like what you're hearing, what I have to say, we have a blog on adamsfinancialconcepts.com. I go into further depth. I go into different things on the blog. You should check out the blog and see what I talk about. And you can like us on Facebook. You can follow us on Twitter at About Radio Money. About Radio Money? About Money Radio. Okay, I'll get it right. And you can also follow me at Mike Adams AFC. So do those things. Sign up, like us on Facebook, check out the blogs, and there'll be more information. I started to talk about 401ks. Started to talk about the fiduciary rule. Big pushback, big controversy from the banks, from the brokerage houses, from the insurance companies, because they make a ton of money on this stuff. They have made a ton of money. One economist from the University of Pittsburgh said it was like pigs at a trough. They were making so much money. The estimates are for an average 401k, a reduction of 1% in the performance of a 401k will reduce 17% available when somebody retires. Think about what 2 or 3 or 4%, and some of the estimates were the hidden costs that were part of the 401ks of what was going on. The hidden costs were up to half of the performance of a 401k. It is a very sad situation. That's why I got into this in the first place. And some of this is coming around all the way around. It's about selection of investment alternatives. There was a time, the traditional method, when a 401k specialist went in to talk to a company about their 401k, they talked about the 3 F's: the funds, the fees, and the fiduciary. The funds, what funds were going to be invested in, what the fees were going to be, and what the fiduciary role was going to be. And oftentimes, they talked more about the first 2 F's than they did about the third F, because most financial advisors were not really fiduciaries. It's part of the reason that this whole fiduciary rule has come out and why it's been so controversial. But the funds and the fees, and there was no regulation. There was nothing on the record to say that you had to select the best funds. There was nothing to say that the funds couldn't pay a lot more to the financial advisor. One fund couldn't pay a lot more than another. And the fees that were disclosed, that were talked about, were fees that made it look really cheap. But in fact, a lot of the fees that came out were hidden and not really visible to the plan sponsor, the employer, or the employees. And most employees thought it was a free and it was a gift that they were receiving. Not so. Not so. And all of this is beginning to culminate now in lawsuits because companies are being sued over the choice of their investment selection. That's coming, and it's coming to Seattle as well. It's really not about the 3 F's, the fees, the funds, and the fiduciary. I think the reality is it's about the 3 P's. The 3 P's. And what that is the first P is performance, the second P is participation, and the third P is preparation. The 3 P's, not the 3 F's, but the 3 P's. There's an obligation for performance. And when performance is bad, the whole score of the plan doesn't look good. When participation is low, that's a real issue as well. And finally, preparation. The purpose of a 401k is to prepare the participants for retirement. There's some benefits to the owners of the business because they can put away tax-free money. They can evaluate and look at how they share their profits and when there's an advantage to do it. But this thing is becoming very public and public record. Judy Diamond, Brightscope, Standard & Poor's now takes all the 5500s and they mine that 5500 and prepare reports that they sell. Your 5500 is what the company does to report their taxes for their 401k. Prepare a tax form. It's called a 5500, and that is public information, and you have companies that are now taking those 5500s, preparing reports, and preparing scores for 401k plans. We happen to buy the Judy Diamond one, and we see scores that out of 100 points, we see scores in the 40s or the 50s. Not very few plans are we seeing that are in the 70s and 80s where they should be. And the very first evaluation point, the biggest factor, is the performance. They look at the performance, they look at participation rate, they look at loans, they look at contributions by the participants, contributions by the employers. But the very first one is the performance. And while the plan sponsor doesn't have an obligation or a liability for how the participants, the employees, allocate their money, they do have a responsibility for the choices that are made. They do have a responsibility for what mutual funds show up there. And that's made it all the way to the Supreme Court. The Supreme Court has said, yes, that's a liability of the plan sponsor, of the business owner. It's a personal liability, not a company liability, but a personal liability. Now, there's some ways to get around that by employing a fiduciary who is what's called a 338 fiduciary. That's what we are. We take the full responsibility. If a company gets sued by their employees, we take that. I'm not hearing. That is where things are. The rule passed. It's going to probably be in effect. It's going to be in effect. And we are going to see the impact of that. Already there has been a number of suits that have been filed against companies like Boeing, Ameriprise, Fidelity about their 401ks. We'll see more of those. But we also know that there's a local firm in Seattle which has launched against some of the holdings in funds. We're going to see more of that. Your 401k, if you have a 401k and if you're the business owner, you could be seeing someone show up on your door saying you've made poor investment choices. There's ways around that. That's why we got into the business in the first place a couple years ago. We believe that that's going to become a driving criteria, and business owners need to really be aware of what the choices are and what the returns are and how you're performing compared to the market. That's crucial. The information is going to be public information. It's going to be publicized. And if you're not aware, one way or another, I believe that you'll be made aware, hopefully, in a good way, not a bad way. So if you've missed any of this program, you can find this, you can find the other programs on our website, adamsfinancialconcepts.com. You can like us on Facebook. You can follow us on Twitter. There's so many places to find us. adamsfinancialconcepts.com. Check our performance as well. I'm pretty proud of that. Not very many people can show the track record we have. And we do have a good track record. I will be back next Friday. I will have more insights on the pension because I'm headed to Nashville for the National Pension Advisors Convention. Till next week, have a good weekend and week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.